All right. Hey there, everybody. Good afternoon, good morning, good evening, depending on where you guys are at. I hope you guys are having a good trading day so far. Today's session, we are going to have a group talk about how staying in cash is still a position. And I personally could not have been timed better with the market because I think this is the lightest I have been on my trading in quite some time. Oh, and I see. There we go. Okay. Sorry, guys. I was in the wrong window. So, hey, Mirza, Lorna, Chad, great to see y'all. But I think this topic actually could not have been done at a better time than it has in the market. Because for myself, for me, first of all, welcome. My name is Allison Ostrander. I'm the director here at Simpler Trading. And for myself, I am much more a trending kind of trader. I love to see trends, whether they're up or down, and I'm more than happy to take trades off them. But consolidation, though I do certainly know how to, it's not my cup of tea, right? It's not where my personality really clicks on things. Hey, Jerry, good to see you. And so, what I typically do, right, whenever I see the market get into a situation like it was probably until like the last 2 days here, where we've attempted a bounce up, but certainly in here we were in very much consolidation, even on the Fed news where we had a great daily range. We didn't actually move anywhere from we just kind of stay stuck in our moving averages. And so, what I typically like to do when that kind of stuff happens is one, if I do find myself getting into a trade idea, I'm usually much lighter on my capital risk. Today is actually a great example of that. Today, I jumped into an intraday style trade. I'm usually on intraday style trades okay with my risk being around $1.50, I would say is around where I get it, sometimes a little bit more, sometimes a little bit less. But today I was very particular about the risk that I wanted to put out there today. And I told myself I wouldn't go over $1 of risk when jumping into a trade idea. And that is because I am not necessarily a fan of one, the smaller daily ranges that people that we up to a 31-point range. It took until the close for that to run like I was yesterday. We stayed stuck for 40 of the day and around a 20-point, very narrow, especially compared to what we experienced last year, which is a whole bunch of volatility, where 100 points was a more range to have occurred than a 20-point range, certainly. Um, the other thing I do, of course, is I just wait for setups, right? And it is a great reminder that staying in cash, right? Sitting on your hands basically is also a trade idea, meaning you don't have to force yourself to jump into a trade every day in order for you to be a successful trader. Sometimes being patient, waiting for the right setup to occur, and then jumping in then is much better for your account as well as your psychology than trying to force a trade each day. And the reason why is certainly learned this the hard way myself. Hopefully I can help you guys avoid some of these pitfalls. But it's very easy, especially as a trader where you're trying to make a living off this, right? If this is your main job and you're trying to make X amount per week to help pay the bills and everything else, then you certainly have that need, right? That feeling that you need to jump into trades every day, that you need to hit a certain profit target each day in order to be successful. But the market doesn't listen to our whims, right? It doesn't automatically give me direction. It has its ebbs and flows. It likes to reset. It needs to consolidate some before it gets into those bigger moves. And so when that happens, sometimes the best action you can take for your account is truly just waiting and being patient. Because at least what I have found in my experience, more often that I try and force, especially being on this side of the mic where I like to give you guys trade alerts and trade ideas to consider, I kind of have that need even more to show you guys like, hey, great trade idea, or here's this. But forcing those trades, right? Forcing something to go through rather than being patient on the setup and being more, more conservative about your capital is a much faster way in turn to blow out your account. And certainly forcing trades and taking those, that starts to affect your psyche, right? You don't feel good about yourself. You don't feel certainly good about your trading when you start to take loss after. In turn, that feeds into what I like to call the dark side of trading, which my Star Wars fans will certainly get, right? You don't want to turn into Darth Vader, really Anakin Skywalker, I guess, before he turns into Darth Vader. You don't want to go out there and kill all of the Jedi temple or anything like that. You want people to have a clear mindset and not let your emotions, your rage, the way you're upset take over your trading, because when that happens, you find yourself, or at least this is my experience, myself not paying as much attention to the technicals and just throwing my money out there hoping something would work rather than letting the technicals guide me into what is a much more reliable and higher probability setup. And the more that your emotions guide your trading, the easier it is for you to continue with those losses and in turn blow out your account, which is certainly never fun to do. And of course, depending on where you are financially, might keep you from being able to trade better setups when they come across in the future. And so please, that sitting on your hands is definitely a position. Being patient and waiting for that setup that you like to trade, whether you like to trade consolidation, right? Maybe this is the setup that for after getting you were this chop and strong volatility last year, person who really enjoys trading iron condors and iron flies. Well, then this right now, this year really is kind of the market that you've been waiting on, where we've seen a lot of consolidation with only days of running before we're right back in the chop, right? That might be your bread and butter. For myself, certainly last year, I would argue was more my style of the market, because even though we had strong days of volatility, they were much more trending on moves. And certainly just with the day having those higher dips allowed for some great moves on intraday moves to lock in profits and everything else. And so it allowed me to be a little bit more flexible with my capital, right? And entering risk tolerance level versus what this year has done. And certainly more specifically, probably the last couple weeks, where we get maybe a little bit of a run and then it stalls, right? And right now we're seeing a little bit of a run. And of course, the question is, will it actually pick up from here? Or are we about to start stalling again and go back into that chop? And so the way that I've adjusted this for my account, and certainly I know people in the Profit Recycling Mastery can attest to this, is I have been much lighter on my capital risk. If my full risk tolerance is roughly around, let's say, for example, it's around $500, right? That's my normal risk tolerance for each trade I put in. Then in this case, I might only be risking half of that, right? 250 might become my max on the risk tolerance, and I keep everything lighter. That way, if the setup's working in my favor, because I'm not getting a clear picture of what the technicals are trying to show me for a trending entry, and I'm already reducing that risk in my account and keeping it ideally from blowing out. And at the same time, sometimes I just haven't taken trades. Like yesterday, I didn't jump into anything. And like I said, out of the trade I took today, I am only in 2 trades right now, including the one I took today, actually, I should say. So I'm extremely light in my account. I am usually a much more active trader. I usually take a couple trades a day, and certainly quite a few in a week compared to what I've seen there. But that's because for myself, like I mentioned, I am much more a trending trader. So when we get stuck in ranges of chop and our daily ranges have shrunken back down to where the intraday, right, may need more credit spreads than rather directional trades like long calls or puts or debit call spreads, then I sit on my hands. I wait for that better setup. And I have not blown out my account this year because, right, I've been patient on waiting for those better setups to occur. And so it's easy for traders to think like that, right? Um, Please try and drill it in that you don't have to take a trade, that also a position as you just are mindful and wait. Because the more you force the trade, and I speak from experience, but I've also seen this plenty of times with other traders that I've coached in the past. The more often that they force trades, the more often that they went into that emotional dark side of trading. And in turn, it wasn't uncommon then to find themselves at my doorstep with accounts that are already blown out, right? That are too weight to manage and salvage because they became too emotional and they kept forcing trades thinking they had to hit a certain profitability each day or each week in order to be successful. And of course, that's an ideal situation. We would all love to, get our percent target each day or each week to see our accounts grow. But the market isn't going to listen to our whims like that. And so we have to adjust to the market because we know the market is never going to adjust itself to us as traders. Which is why one of the things I telling people is the only thing that we can truly control in trading is our capital risk, right? None of us have Warren Buffett size accounts to really be able to be the market maker, right, and change the ebb and flow of how it's going. The only thing that we can do is try and look at the technicals for the best occur on a move. And then more importantly, the only thing we can control is the capital risk that we're willing to put out there into that trade idea. And either way, either the technicals will work out and follow through, or they might cancel out. But at least you've defined the amount of capital risk that you want to put out there, and you've protected yourself in your account by not blowing it out and not over investing or not being emotional when there really isn't a setup that is clear cut for you to take. You can certainly relate to that. So hard to recover as a trader after those really big losses. Felt like a pivotal moment where I either would give up or commit to figuring it out. Absolutely. And like I said, I've certainly been there myself in the past. When I first started trading, I loved when I had the big wins, but when I saw a big loser, right, wipe out my wins, it kind of like shocked me. Like, how is this even possible? Actually, what changed my whole focus on trading to be around risk was to make sure that my risk versus reward scenarios and the capital risk that I was putting out there in general never blew out my account, and also to where a winner can easily offset multiple losers. Because I've been there personally, but I've also seen it plenty of times where it can be really hard for a trader from a psychological standpoint to get those big losses, especially if it's several in a row, right? Now, all of a sudden, you see your account with a huge red number for the year rather than a nice green number to see. And it can be really hard for them to turn off that switch of those bad habits that they were doing that led them to those losses and not figure out a way to turn back around to get their mindset once again on that Jedi mind path in order to be able to not only some wins, but also to be able to their account. And that's why, of course, my focus is so much around risk, what that risk tolerance means for you, knowing that you don't have to necessarily put a lot out there in order to get a big return. A great example of this is actually on one of my trades that I have, being in the $500 challenge. And so, for those of you who don't know, basically, I have a signal that I am watching for next quarter about to come up that basically every time it's worked out in the past is a clue that the market see some bigger selling to the downside. And so this signal printed at the end of last year, and usually the follow through after the signal prints happens the second quarter after it prints. And so that means because it worked out beautifully to where the signal printed at the end of the year, that means the second quarter of this year, the quarter two, has that possibility of more selling. Now, once this technical has worked out every time it has in the past, right? Every time it's printed, it's followed through the same way. Follow through, and we saw it follow through in 2001 in a big way, and we saw it follow through in the 7 way. But does that mean it's going to follow through this time? No, it may not, right? It may be the first time that this technical signal doesn't work out. And so what do I need to do as a trader? Well, I need to be prepared for that possibility in case that bigger amount of selling that I'm potentially looking for does not happen. So how do I do that? I do that by controlling my risk. And so here's a breakdown for the 500. For those of you who don't know, it's where I risk only $500 and see how much I can grow it. Last year was a great year for the challenge. We'll see if we can repeat that again this year. But in this $500 account, I have only risked $1.30 on this trade idea. Am I risking the full amount of the account to take this trade? Not at all. I have 370 of capital still left in the account to where if this trade idea doesn't work out and let's say I take the full loss on it, that's okay. I have capital left over to try and manage back. But what does my profit potential look like on this? Well, it is a 40/30 debit broken wing butterfly. So just because I think it's a bit easier to see this on Tasty, let me pull this up over here so I can show you guys how this trade actually looks. But this is set for the June quarterly expiration because I'm anticipating this, it follows through to happen sometime within the next quarter. So I gave myself the full quarter for it to try and work. Out of the money with the 3,500 long, 34.60 as my short pin strike, and then 34.30 as my other long. So it's a 40/30 debit style broken wing butterfly, and I'm technically in it for $1.30 of capital. It actually had a little profit not too long ago, and then of course this bounce up has brought it back down some. So I think it's still a viable trade idea if you're not in it and wanted to test it out. But right, it's a very small capital risk. What's my max profit potential? My max profit potential is 38.70, meaning that if by the end of the quarter we find ourselves at 34.60, I have an excellent risk versus reward scenario. This profit could easily cover that I've, taken potentially in the $500 challenge account. Not that I have any losses yet, but it could take care of those losses. It could take care of the losses that I've taken for the year in the mastery and still technically keep me net ahead overall. If it goes completely in the money, let's say it's a bigger move than I'm anticipating, and we go further to the downside by the end of the quarter. Well, the beauty of a debit broken wing butterfly completely in the money, it can still allow for a profit. The way you figure that out is you take the difference of spread width. So there's 40 points on the debit spread minus 30 points on the credit spread, which would mean the butterfly itself would cash settle for $10 if it was completely in the money by expiration day into that market close. Well, 10 minus $1.30 is still an 870 profit. And that, of course, is a return of about 600, just shy of a 670% return on my capital risk, right? Not a bad risk versus reward scenario for this trade idea. And so you can see here, I'm being very mindful and have a very small capital risk, but something that allows for a very nice profit potential to where if we do get that move lower, it's a really great risk versus reward scenario. And the way I have these strikes set up is to the downside. And for those of you who maybe missed my aftermarket webinar I did earlier this week, please feel free to go and watch the YouTube recording because I do go over some of the targets I have to the downside. I'm happy to post the link to you guys. For those of you in the free room, I posted it actually a little while ago, and in the room drive, I do have my notes from my trading journal that I've taken pictures of to share with y'all. So you can also check out the room drive for how the math works and those more specific targets. But there is the YouTube link in the free room. And then here it is to y'all as well over on YouTube or Twitch if you want to check it out. But I chose the strikes with probability that, okay, if we do get the bigger sell off to the downside and the signal does end up following through, then just a test of the lows that we had last year at 34.91 would put this spread at least partially in the money, right? That's why I chose the 3,500 strike. And so even if all we do is test the lows of last year and stall, that on a debit broken wing butterfly would still allow for a profit. So that basically the idea behind having a good risk versus reward parameter around your trade, as well as understanding that sometimes sitting on your hands can be the best way to go about trading if you're not seeing a clear setup for the technicals on the charts or a clear trade setup that you potentially want to take. Because it will come eventually. Type of, it's not going to stay in consolidation, not going to stay in a bullish trend forever. It's not going to stay in a bearish trend. It is the ebb and flow that we see. And so if you like to trade a particular type of market, right? Wait for the signal. Don't force anything, because the more that you try and force something to work, the more likely it is that you're going to lose and in turn potentially blow out the account itself. And then 007, great question. So he's asking, if you're having a really great week and then have a losing or meh day, how do you keep yourself in the Jedi mindset? Well, one of the ways I keep myself in is having an understanding that I am going to have a loss, right? That's just the nature of trading, unfortunately. You show me a trader that has had a hunt win rate, and I'll either talk to them and figure out they're a new trader, right? So they're just on a good winning streak at the start, which was me at the very start of my trading. That's why when I did take my first loss, I was like, what happened? Right? Because I didn't have a grasp on risk. And so it wiped out a good chunk of my winners to where I was like, how did this work out? And that changed my focus around. Or they're lying, right? It's the likelihood of them being in the game as long as I have, or as long as JC has, or Warren Buffett has. We've even Warren Buffett, right? We've all had losers. The way to work around that is understanding that that is going to happen sometimes and being okay and accepting that as a possibility. But the second way around it that I have found is going back to that risk, right? Having those good risk versus reward scenarios. So that way, it's not one loser that's wiping out multiple winners, it's one winner that's taking care of multiple losers. When you have risk versus reward scenarios set up like that, then it's much easier, at least from my perspective, to take a hit psychologically, because I know that I have trades and strategies in my toolbox that can work to make it up, right? And certainly by not over investing in the account itself. If you throw all your money in your account at one trade idea and that ends up being the losing trade, you're going to feel sick, right? It's not going to feel good. But if you've divvied out your account to where you're not loading the boat in any one trade, then taking that loss, it doesn't feel great, but it's okay, because you know you have capital still in reserve to be able to make it back. And certainly if you guys aren't doing it already, I'm sure you're already doing it, 007, but if you're not, please, please, please keep track of a trading journal. Because if you don't have a trading journal, it is very easy to continue to make the same mistakes over and over again, because you're just not understanding that you're doing that, right? It's easy to get stuck on whatever and forget what's happened the past week or the past month. A great example of this is actually not last year, but the year before. Let me go 2 years back and see if it shows it. One of the setups that I used to use to consider putting on a hedge trade was whenever there was a break ATR trailing stop and more bullish trends, right? So when the bullish side of the ATR trailing stop broke, that was usually a good, you might see further of a run to the downside, and it was a good place to put on hedge if my account was mainly bullish. But 2 years ago, at least for a good chunk of that year, that wasn't happening. We kept getting a fake out move where it would be TR trailing stop, but then still basically hold the price level and bounce back up. Um, So there are a few examples of this that happened earlier in the year back in 20, but I'll show you the few that right now. So here, for example, we broke the ATR trailing stop. Usually that's a good sign to play it short, leading down. Notice early break though. Right? It broke the level, but then it stalled in this range, actually bounced. Back here, barely broke the ATR trailing stop, and then we bounced. Here, we barely broke the ATR stop, and then we bounced. Like I mentioned, we would get usually a stronger move to the downside where it makes sense to put on a hedge at that point. The hedges that I put on when this started to happen weren't working. After the first few times it didn't work out on the daily chart, I told myself, okay, Allison, go back in your trading journal. This isn't working, right? You've consistently shown the last 3 times here, it's not paying out the same way, meaning that the technicals are shifting. That signal that used to work out well in the past, it's not what's needed right now in this market. And so I put that tool back in my toolbox until it can prove that it's going to work that way. And it finally started to work that way later in the year. Like here, for example, TR trailing stop, there was that pull back into the 100 and actually a little bit below it on the second run. Here was a break of the ATR trailing stop. You can see it had downside, right? So there it started to work out again. But for a good chunk of 2021, it wasn't working out. And so if you don't have a trading journal, and if I didn't have a trading journal, right? And I usually use that as a place to put on a hedge, I would have played that every time. And I would have only 2 times in that year out of like the 5 times, right? So that is a great example of keeping track of what's working and what market environment, what's not, and then understanding that if something's not working, you shift gears. You're not going to use a hammer to build an entire house. You need a table saw, you need sanders, you need to put up drywall, you need screws, right? You need all these other tools in order to build a proper stable house. And the same thing is true for your trading account. Unfortunately, right? You're not going to use the same strategy typically every time to be able to jump into a trade. You need to understand what strategy is working in what market environment and then use those tools accordingly. And Jerry's asking, what are you looking for to go back to a normal position size? Honestly, I'm just waiting to get out of this chop a bit more. So you can see our moving averages are completely consolidated, trend down, gotten it down. Even today, we've had the last few days, we're about to head resistance and price resistance that we have here that could drop us down again. So the quarterly signal I'm watching for next year, I'm anticipating a bit more volatility to happen in the market if it follows through the same way. So that's kind of what I'm waiting on, is to see if that signal for next quarter starts to work out. And if it does, then I'll probably bump back up into my normal position sizing once again and probably be a bit more active in the trading than I have recently. If it looks like it's actually going to be a year like it was, I want to say in like 2015, 2016, for those of you who recall, that I'm thinking of, there was like 2 years, a year and a half basically, were extremely choppy. We weren't quite getting a strong move up, but we weren't getting a pullback or break to the downside of a year. And as soon as the monthly chart pops up, I'll show you guys talking about. But if it ends up being a year like that, then it probably means that I need to go into my toolbox and start using strategies that I'm not a big fan of necessarily, but that are the ones that are viable for that market environment. And yeah, 2015 into 2016, that's what I was thinking. So back here, I attempted to move higher. We had a little bit of a pullback, but it wasn't a strong pullback. We never entered a bearish trend, and we found ourselves in chop, right? And so if you remember trading this was very annoying in my opinion, because we weren't really getting trending moves for the year. And though we did have maybe a nice month, it didn't last very long before we went back into consolidation. It wasn't like this where it was a nice trend higher. It wasn't like last year where it's a nice trend lower. It was just stalling. And keep in mind for momentum to reset, which is what was happening, you don't need a big reset in the price. All you really need is consolidation happen. And so if it starts to look like a year like this, where we're just consolidating, then I'll probably change up the strategies that I normally use and look for non more non-directional strategies, things like creds, iron condor, unbalanced butterflies, things that benefit in both consolidating and a potential trend move if it starts to occur. This is what I typically like to do, which is long calls and puts, debit vertical spreads, broken wing butterflies that usually look for a more directional move in order to be successful. Yeah, and exactly, Chad. Risk is definitely the only control we have. So, and yeah, it certainly can feel good when you've managed your losses well. As weird as it does sound, because what that does is it teaches you a really good pattern of learning when to cut things when it's not working, right? Or with if you're like me, right, usually the capital risk I put out there, I'm usually okay on losing 100% of it, but that's why I've been much smaller on my capital risk this year because I know the type of market that we're currently in. And so I need to reduce that risk in order to be okay that if I take that full 100% loss, then it's okay for my account. It's okay for my psyche, right? And I certainly know that I have money still in my account to be able to trade with to try and make that up. So I'm just catching up on some of the chat and questions here. Yeah, and definitely a trading journal helps with that exactly. And yeah, and that is a really good point, 007. If you can survive the inevitable setbacks, right? The losses that will l- inevitably happen in your account, because as a trader, we've all taken losses before. If you can have a good understanding of your risk versus reward and you can manage yourselves to accept that you'll sometimes and be okay with that, and you have that good grasp, not blowing out your account on those losses, then it makes it easier to learn one, how to sit on your hands and wait for those better setups. So ideally, you don't even have the possibility of taking a loss. But two, when you do, you know that you're not blowing out your account and you can try and recoup it with a better risk versus reward scenario on a winning trade that will also inevitably come, right? You won't have 100% losers, you won't have 100% winners. That's just the high probability of how trading works. And then 007, I keep a handwritten journal for myself. Anytime I write something down, it sticks much better in my head. And so I have a whole bookshelf behind me. It's filling up quicker with trading journals that I have over the last several years. But I personally keep them handwritten, and then, of course, if you have Thinkorswim, a great Thinkorswim is the on-demand feature. So what I'll typically written journal, and then certainly at the end of, like, a quarter or definitely at the end of the year, what I typically do is I'll go back through my trading journal and see what was working and what wasn't, and then I'll use the on-demand feature here where oh, hopefully this won't slow down my computer. It may, but basically when you click the on-demand feature, there it goes. You can will adjust accordingly to, and it's a really great way to go back and say, "Okay, this is exactly what the charts were looking like. This is exactly what the option chain was looking like, right? How is the theta working that day? How is the volatility and the extrinsic value versus intrinsic value work that day?" And then see, right, was 3 months prior to when you're looking at it. So definitely for anyone who has Thinkorswim, I find that to be a very useful feature to use. Um, when you go back and you're going through your trading journal to see what is working and what isn't, to help kind of identify what you currently use and what type of market that you're in. But that is my time, guys. So thank you so much. I, I apologize if my audio is going in and out there, but it is my time. So thank you so much for joining me. Great rest of your trading day. As always, may the trade be with you. And I look forward to talking to y'all next time. Bye, guys.